Hello, everybody, and welcome in to Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day, and on this episode, I'm very excited to be welcoming in trader Ferg to the show, a full-time trader with a focus on uranium, oil, and coal, and the author of the Trader Ferg Substack. We're going to dive deep on all three of those commodities, oil, uranium, and coal, and find out where he's currently investing and searching for value right now. We're also going to get his outlook for gold and silver, both the metals and the miners. With so many bullish on precious metals, is this a time to be piling in, or could we be due for a correction? All of this and so much more in today's conversation with Trader Ferg. Ferg, it is great to have you back on Commodity Culture. It's been a while. I want to kick things off by discussing the uranium market. We've seen both the spot price and the equities potentially staging a recovery here after getting beaten down. It's interesting because, I started investing in uranium around 5 years ago. And at that time, everybody was saying, hey, just put your money in this sector. It's a no-brainer. After 5 years, you're going to cash out. Of course, at that time and in years prior or years after that, uranium Twitter was such a hub of memes and people just rejoicing we're all going to be millionaires up ahead. And now it's very, very quiet. You have a few people poking their head out here and there. There's no more memes. It's mostly just concern and people declaring that the thesis is dead, and hopeful posts where people are saying, hey guys, what does everybody think is going to happen to uranium, making polls and stuff like that, just hoping that there's going to be somebody out there to give them something to look forward to. Is the thesis just taking longer to play out than most people think it is or think it should?
Yeah, well, that's my take. I was as sold on the fact that would be in a sort of raging bull market with prices doing silly stuff by now. And I didn't expect us to still be having this conversation now. So not to say I was any wiser than the sort of uranium bull crowd. I've certainly shared a lot of the optimism that it would really run. And I think that's been true of the whole energy complex. I think when you look back at, like, even my mentor, he says when you look at what's happened with the sort of the craziness of the stock market back in 2021, 2022, and then it rolled over, it looked like that was kind of the start of the whole commodity cycle was getting underway. And then we've had this even bigger boom with AI and reversed a lot of the trends. And now here we find ourselves where commodities have really suffered. And I think a lot of people thought that they were just going to have an easy ride from picking commodities in general at the bottom. And the more painful it's been in commodities has been when you've gone into something that doesn't have any cash flows to kind of give you any cushion. So if you went into something that has, something like coal stocks, like, even though they've been beaten up as well, but if you went into something that's trading at sort of 2-3 times EBITDA, then you kind of got a base that you bounce off. But if you're going into something that's like a mine that's all the promise of what it'll earn in the future, you get absolutely brutalized. And that's what we've had with uranium. And to answer your question, there was obviously a lot more floating around than everyone, myself included, thought. I remember listening to John Borsoff back in 2020. He said it would be sort of a 2025 story. And to see him now sort of saying the market's broken and he's just sitting on his hands and not going to make final investment decision until he sees what he thinks is a true reflection of the prices tells you a lot about the sector. Something with particularly with uranium, but also with oil as well. If you didn't actually know the price, just everything's quite constructive. But as soon as you see the manic equities, just does your head in. And so, like, I found myself, I was just reading a few earnings that was from some offshore companies, and I was like, these really upbeat earnings are moving in the right direction. They're adding backlog. Like, this is great stuff. And then I open up the stock chart, you're like, oh my God, this doesn't reflect it at all. And I kind of feel the same with uranium. But yeah, like you see nothing but positive news, and then you spew when you open up the stock prices. Granted, it's they to be gaining traction at the moment, which is kind of fascinating as well. When you see the one that I've been kind of keeping an eye on is the discount to NAV with Sprott Uranium Trust. That's creeping down. That was 10%. Now it's down to just over 5%. And if that can sneak even a cent back into positive and the market's this tight, that's a pretty fascinating setup when you've got short interest just massive across the board. Like there's feel the shorts have definitely been right to date, but then when you look at how much they've leaned into the position at lower prices, a large percent of those shorts positions are now underwater. And if it starts to run here, like you can bring up, I always use Shortman. There's like just a website for ASX, and you can just work out the where they started building the short position and some like where they maxed out and what their sort of rough average sort of price they would have been that they would have borrowed stock at, and the likes of Boss, Deep Yellow, Bannerman, they're all starting to get very close to what they would be above their average cost, and they'd have to consider covering that position. Granted, at the moment they obviously probably are hoping that it rolls back over with the geopolitical, the whole trade war and all the uncertainty. But if Sprott Uranium Trust does tick over into that positive NAV and all these are underwater, that could be fireworks. So yeah, I'm watching that, but I think I've got so much PTSD probably to see it all rolling over again and have to wait another year or two. Not smart enough to know what the catalyst is. And it's funny, even with the current rally, like what started that, what actually kicked that off. Like we'll probably assign some reason in hindsight, but to me there was absolutely nothing which kind of put it in the bottom other than just sheer exhaustion, which comes to your point as well, that my experience in markets is like once the last sort of retail tourist gets flushed out, then it'll start the next up leg. And that's kind of how markets work. If when everyone's sentiment's riding high, then yeah, you're probably gonna be in for a rough time. And once you can't find anyone that has anything nice to say, then a bottom's probably not far away.
And now a quick break to hear from our sponsor, ARC Silver Gold Osmium owner Ian Everard is considered one of the most honest and level-headed gold and silver dealers in the United States, praised even by his competitors. So give him a call today to take advantage of the specials right now. Silver Kangaroos 2023 1-ounce coins, mint fresh, only $2.47 over spot. Mint fresh silver maple leafs 2025 coins, 1 ounce, $2.87 over spot. While supplies last. Reach out today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And now, back to the interview. Do you think the lack of a real functioning futures market, like what type of impact does that have on uranium? Do you think that would help it? And then as a follow-up to that as well, institutional investment in the sector, obviously not very large at present. Could that be a catalyst? Should we see, all of this positive news for nuclear continuing to advance? Do you think we could see more institutional investment come into the space, and that could potentially start the next leg up?
Yeah, 100%. Well, yeah, to start with, not being a sort of a futures market, there's nothing really to keep the sector honest. I see this because I play around in a few niche commodities, and like there's one I'm thinking in particular. Like I can play around with the bid offer just myself. Like it's kind of ridiculous when like with spot, when it gets down to only sort of a few $100,000 pounds that are traded back and forward. Like yeah, they can play all sorts of games, and there's no big deep futures market to keep them honest. So yeah, but the thing with that is when you zoom out, you're just seeing the the volumes just keep going down and down and down. And it is similar to term, like you know what replacement rate is, and you know that they haven't even been close. Like last year was only half, and they have to replace those pounds, and it's frustrating not knowing when. Like it's kind of annoying that you can't even kind of look it up in their filings. Apart from there's only Constellation's the only one that you can actually look it up, and everyone else they kind of just hide it in the earnings, or they don't hide it, they muddle it in with everything else, so you can't actually pick out what they're setting aside for fuel purchases. And yeah, you know that they have to at least sort of have that replacement rate, that's sort of 185 million pounds, and historically they've gone well above that. When you go back to the last bull market, they were doing sort of 130, 140% of replacement rate. And then you go down to spot, and you can see that that's just been getting the amount actually contracted. What was that back in 22? It was the amount of pounds that were actually being delivered into contracts was 10 million pounds, and then it was down to next year was down to sort of 5, and then last year was down to like 2, and it's just all drying up, and it's fascinating. That's all that's happened. Well, yeah, everyone's just throwing in the towel and moving on. It's just too much pain in the equities. Like it's a sector where there's no great expression of the trade. Like since you don't have the futures market, you can't just express it in a nice way. And then there was also all the sort of scaremongering, even now with Sprott running out of cash and having to sell pounds into the market. And I think that was the end for a lot of people. They were just like, oh, that's what all the shorts are hunting for. I'm just I'm the sort of patsy at the table, and I'm just going to get further punished. And it was interesting when that narrative kicked off. That seemed to be around when it sort of put her in a bottom. But yeah, I've still got no idea what the actual catalyst will be. And as I said before, I kind of seen it being largely hindsight. We'll look back and label it then. As for institutions, yeah, they've got to be thinking about it. I think I was watching, forgetting his name, runs to the Tribeca Uranium Fund. He was just saying like it wouldn't be tough for them to push the NAV even like 1 cent above, raise a whole lot of capital and push that up, and the effect that would have on the whole sector without much money. And this is what you actually saw like last bull market was, they sort of, a lot of hedge funds went in there and sort of did the trade, which is, it's interesting that hasn't really been done this time round. But no real insights other than the setup looks as good as ever. The fundamentals are all intact, and it's just been a very long, frustrating wait, and we've obviously far more pounds floating around, far more ability to flex than everyone thought was possible. And it's kind of sad that it's not sad, I guess it's just a reality of markets that most people that got in the trade have been flushed out, and those that have waited it through have had a horrific drawdown. Like to get to the actual bull market, and a lot of these we'll get to it's been in a bull market, but to have survived this drawdown in a lot of names, be looking at sort of 60-70% drawdowns, which is beyond most people's ability to stomach it.
So when it comes to the uranium sector, which areas of the market are you currently either invested in or looking for potential entry points? And how do you go about evaluating a uranium company? Obviously, that's a very deep question that we could go on forever about. But, these companies most of them are not producing uranium, so they don't have any cash flows. You've got, obviously, the two big producers, Cameco and Kazatomprom. And then you've got some other ones now who have started producing in some smaller quantities. You've had a lot who are running into problems. How do you, first of all, which areas of the market are you currently invested in, looking for opportunity in, and how do you go about evaluating these companies?
When I first got involved in the sector, I wrote a piece. I've got an old blog that's called just traderferg.com, and I just came at it from the angle that I'm not that smart, and so I'll just go with a care and maintenance mine, and I'll load up on that when it gets really hated. And so that was my original big positions. Were getting in on Boss and Paladin, and then really lightened up those the end of last year because it's just mining's hard, and I was just got beaten up as well with just like miss after miss, and just seen it across the sector. Like it's kind of crazy. Almost no one is executing on guidance. Like everyone's just there's been some horrendous, like just looking at like Encore and Paladin obviously as well, and just have seem to have a new issue every month that punishes them. And yet with all that bearishness, it's actually like feeding into the bullish long term narrative. Like where's all this supply going to come from? These guys just go from issue to issue. So with my split now, have some physical, still have a little bit of producers, and lean more heavily onto the guys that have got that are ready to go but holding off their final investment decision. They're just sort of pulling the fingers to the producers and say, I'm not going to sign contracts at this until the price is right. And I think at this point, that's almost a place to be, is where they're fully cashed up. They've got a decent amount of shorts, so you've got like a whole lot of petrol just waiting for a spark, and almost like tiered assets. I've always loved Bannerman, the way they can do the Tango 8, and then once that's funded, then they can move on to the larger Tango project. I always kind of viewed the space as having sort of a risk on, risk off. Like you've got the higher cost African miners, which have been pretty tough hold, obviously with them being higher cost and viewed as riskier, versus the, sort of the US names, which are a bit safer jurisdiction, and a lot of them are ISR. So obviously didn't need as much capex, and but now I just see. I think with the setup and how I just love listening to John Borstoff talk through it. He's just like, there was a point at which this could have all been managed quite well if there was realistic numbers, could have been sort of contracts signed, and it would have all kind of got reasonably into balance. The fact that there's like the replacement rate, there's just been essentially sort of half replacement rate, means it's definitely shifting more to there's just going to be some far more volatility and crazy price action. And when you kind of reach that conclusion, you don't want people that have you don't want miners that have locked in too much of forward production. You don't want them sort of locking in fixed contracts, and you want to have a miner that can capture a lot of that potential future sort of upside.
Yeah, some great thoughts there. I want to move on to another sector that's been hated and forgotten, and that is energy. WTI crude holding under $60 at this point. The stocks have been absolutely decimated. Is this a contrarian's dream, or should we be proceeding with caution here? Because much like the uranium thesis, the setup for both oil and natural gas over the long term seems incredibly favorable. Would you agree there, or is this a time to be proceeding with caution when it comes to the energy space?
Yeah, well, I think it's a contrarian's dream, but I've thought that for a while. So I've obviously been beaten up with just how extreme it's got. Like there's nothing more painful than thinking something's crazy cheap and just see it get cut in half again. So with that said, I think this is really setting up for a massive bull market once we get to the other side of all this uncertainty around demand and where the trade war is going to end up, and just any exhaustion in anyone that's involved in this. It's just it's been absolutely brutal, and in commodities, and then particularly in energy. And there's just so much misinformation as well. Like I really enjoy following Anas Al Hadi and HFI Research, and they just almost every one of their pieces start with like, here's the latest Bloomberg article, and here's why it's like completely wrong. Like just the headline is couldn't be further from the actual reality, and just show it with numbers. And it's with oil in particular, it's quite interesting how everyone is extremely bearish, and yet there's been almost no builds. We're seeing supposedly OPEC, like you can go back and look at any of the times where there's real oil bear markets, and it's obviously overproduction, and you see huge builds. And this is all on the expectation of builds, which is kind of interesting when no one really knows how this is going to play out with the trade war. And demand was quite strong going into this, so the fact no builds, and then on the other side is everyone's all like this massive spare capacity out of OPEC, which isn't really true when you look at what the OPEC members were producing. Look through their data, a lot of them were cheating, and they didn't cut at all. It's pretty much Saudi that shouldered the majority of the cut, and so everyone sort of, there's just multiple theories being thrown about why they're pushing production back onto the market. But to me, it looks like they're, number one, they're jawboning it and really trying to kill shale, and so they're just pushing shale well below its cost curve, and there isn't actually that much spare capacity to put back into the market. With Saudi having shouldered the majority of the cuts, it's only sort of that just over sort of 2 million barrels a day that they need to sort of work back into the market, which isn't as oversupplied. Granted, like we have an absolute doozy of on the demand side due to the trade war. If we have like a big recession, then sure you can see a lot of demand destruction and maybe builds on the back of that. But to me, it just looks like a great setup if you can look through the next year. And I've been adding, and the only question I have is like how bad it could be and what prices we could see that I want to take advantage of in the next few months. And that's what really plays on my mind. Is it's always tough in this game to say something's cheap, and we might just see a kind of another sort of a March 2020 moment where something I love goes down and another sort of 50%, and there's just that moment where it's just absurd, and questions how much cash to carry for that moment when it may or may not happen. Granted, a lot of the stuff's already cheap and already been beaten up, and that's what I battle with.
And how about oil tanker stocks? Because you've spoken a lot about the thesis for oil tankers in the past, and the setup does seem once again favorable for the long term. My lone oil tanker stock, Scorpio, was I was feeling high and mighty. I was like, I figured this out, guys. It's up 60%. The thesis is intact. Now I'm down. I'm down over 15%. Kind of round tripped it there. The long-term thesis makes a lot of sense. Is this just a matter of weathering the storm in your view? Much like, I mean, it's funny, we're talking exclusively about assets that have a great long-term setup, but have been absolutely decimated in the short term. And here we are with another asset class that's in that category in terms of oil tankers. How are you currently viewing the sector?
Yeah, so I've owned oil tankers, owned product tankers, owned a lot of it over the last few years. And what the conclusion I kind of came to with it is all the stuff's going to do well, but I want the stuff that's got the worst order book. So I want the tightest supply with the least capacity to build them. I want, kind of called it like being in the back of the queue. And I just went through all the order books where it was sort of like where obviously LNG tankers at the front, they've got a decent big order book. The carriers have also got a solid order book. Then you got dry bulk, which is pretty damn low. Like the likes of Capesize is really low. That's really interesting. And And then you've got like dirty tankers, product tankers. They're all quite low as well. But I just got really attracted to the what I call it the back of the queue was the one with the tightest order book and the least capacity to build them was like drill ships, and that's why I just moved most of my capital out of all the front, like all the dirty tankers, product tankers, and just moved it to where I thought the tightest supply demand. And granted, it's been rough because I've been really beaten up lately, but I just think that trade will have a huge runway once we see this sort of current oil pricing work through and shale continue to roll over. So we've already seen shale roll over. Like if you actually back out a lot of the adjustments, shale's already topped out, and you're starting to see a lot of the figures come through of how badly it'll roll over when you look out a year. Because it'll hold up for a while with a lot of the hedges, but sort of a year out from now, I could see it down around 1 million barrels a day, which is a huge deal when that was banked as being the sort of growth engine moving forward. If you look at where was the IEA or OPEC, they were sort of banking on it, adding another 2 or 3 million barrels out to over the next few years. So that sort of difference is going to lead to an extremely tight market. But yeah, again, have to have patience and understand that we're probably going to see some silly prices over the next few months on the back of all this uncertainty, which I always hate. I always hate when someone like, oh, it's so uncertain. Like it's always uncertain. You just got to, when it's clear the prices won't exist anymore. And so everyone's like, oh, I'll wait till I know exactly what the demand destruction is and know what Trump's done. And once you know that, all the stuff will be up. Yeah, be up multiples on some of it.
Yeah, interesting comment there about uncertainty, because when you look at like the greatest investors of all time, your Warren Buffetts, your Howard Marks, etc., they're always very uncertain. You know, when you read Warren Buffett's letters, they're just filled with uncertainty. Same with Howard Marks' memos. It's just that I think uncertainty is actually a positive trait to have, like understanding that nothing's ever fully knowable, and then how to operate in that environment when there's so many unknowns. So yeah, and especially in these sectors we're talking about, the uncertainty is much higher in many cases than a lot of other sectors. Let's talk about the most hated of all commodities, coal. These stocks also have kind of round tripped recently, right? Like a lot of jubilant coal investors, huge, increases in a lot of these coal stocks. Some of them haven't round tripped completely back, but we have seen a large drop off recently. Are you deploying capital into the coal space right now? Is this an area where you think we could see another run up in the stocks?
Yes, I continue to like coal for the long term. I think it was always a play on developing market growth. It's with the sort of low, we've had sort of a low growth environment in the last year, and that's really hurt demand for coal. It's kind of important to remember whenever you to not extrapolate low growth periods, because that's when renewables, like when solar hydro, takes up a lot of the slack, and so it seems like there's it bounces back quickly when you look at the history of it. And this is what I was kind of talking with oil as well. If you look at the history of coal demand, it bounces all over the place, and in particular with China, so they were worried about another scenario like 2022 when they had power shortages. So they really ramped up domestic coal production. They ramped up imports, and then they had quite a mild winter, and coal generation was down for sort of 4% for the start of this year, and so they've built massive stockpiles, and prices cratered. And I just think you need to look through that. I think with what the US is doing, going quite isolationist, it's we're going to see developing market's demand sort of really benefit on the back of this. As the world's a big place, and it's not just China and US. Even though they are obviously um, a big part of it. But when you look at the sort of the supply side, it's particularly with the higher quality coals, whether it's sort of Newcastle or particularly Met. I really like both of those, and yeah, you can get some companies at the moment where it's priced so cheap. With some of them you've got a whole lot of other commodities thrown in, and I find those the most interesting. Almost shifting a little bit away from sort of pure play coal names, because some of these have had far higher multiples in the past, and I find that really interesting. So the overall trend is just to be really careful, extrapolating sort of energy demand and low growth, or even recessions. Sorry, when there's sort of slow periods, because you can just look back at how quickly it's rebounded.
Now, you like beaten down sectors where nobody is paying attention or people have thrown in the towel. How do you feel about gold right now, which seems to be gaining a lot of traction and a lot of momentum? It's interesting because pretty much everybody I speak to on this show, regardless of their view on the global economy, on the broad market, they all pretty much say that gold is a buy right now. Gold is a trade that is going to hold up moving forward. How are you viewing both the metal and in particular the mining space at the moment? Because that's also been an area where people have been pointing to it being undervalued at present. Are you attracted to the gold mining sector right now, or is it too overbought? It's not hated enough, I should say, in your view.
Yeah, no, I do like it, and I bought it. I think a good check is just to bring up GDXJ and GDX and have a look at the inflows. And when you look at them, you can see they've just been had constant outflows for last year. So the gold price has really been running on the back of central bank buying. There's been no retail involvement at the moment, and it kind of reminds me of when I first really loaded up on coal back in 2021. I was like kind of wondering what I was missing, because the coal price was running and the miners weren't moving. And I was just like, oh, these should be correlated. And sure enough, they just played catch up. And I think that's probably I think that will happen in the gold space, is that when these earnings come through, the miners will play catch up and should really trade at a premium to where gold is. And it's just going to take some time, because people there's the whole theory that crypto sucked a lot of the speculative interest out of gold. You've also got the fact that a lot of people sort of expect it to pull back, and it's definitely a certain amount of I saw like a survey that 50% of I believe it was fund managers thought gold was was going to be the best performing asset this year. And I never like to see that. Like when everyone figures something would be the best performing, it usually disappoints. But yeah, I think gold miners play a great game of catch up, and they make a lot of sense here. And ultimately, if gold's going to be used to sort of recap the system to an extent, I think it goes an awful lot higher. Something I've sort of come around to the fact that we might not see a whole lot of gold to oil or gold to silver ratios mean revert the way they have historically. Like, you always got to be careful saying this time's different, but if they are going to use it to recap the system, then yeah, it could head an awful lot higher over time. And that's not also to say that any of the commodities are less attractive, because I just see, like, when you have depressed prices and you also have quality companies which have great leverage to those commodities, I kind of almost sort of map I have in my head is gold's going to grind higher, and it'll drag all the rest of the commodity complex up behind it, and there'll be sort of almost squeezes at certain times, a lot like the 70s, where gold really outperformed oil, and then oil played a game of catch up, and then silver played catch up, and by the end of the decade they were all had roughly performed give or take a little bit, all in the same sort of arena. And so I could see something similar happening across the whole commodity spectrum. And that's when kind of just pays to ask, where can I find the most quality businesses? And gold miners are tough. I don't back myself to pick a good gold miner. So I just kind of prefer the ETF. And whereas I think you're a lot more spoiled for choice in energy markets, particularly oil.
Great thoughts, Ferg. This has been a fantastic conversation. So many insights shared. Tell us about your Substack and where people can find that, what it is you write about there.
Thanks, Jesse. So yeah, my Substack's just kind of what I'm doing with my portfolio, how I'm trying to outperform the markets, I guess. It's just I've always loved hanging out in hated areas and trying to kind of picture where the world will be in 5 years. Hopeless at thinking where it'll be short term, but I think if you can think in that time frame, you'll be well rewarded, particularly where we are now with commodities and how hated they are. Like if you can stomach the volatility, there's just a ton of opportunity there. And the thing I'm most scared about is kind of looking back and kind of having missed some of these big trends. So yeah, that's what I just spend all my time analyzing. I send out a weekly free email, which is just the most interesting thing I've read, most interesting podcast, quote, and just something I'm kind of pondering. And yeah, the rest of it's just me writing about what I'm buying or thinking of buying.
I'll put a link in the description below. I recommend people at least sign up for the free version to begin with to get an idea of where your head's at when it comes to that newsletter, because it's one of the most informative, including the short form free one. When it hits my inbox, it's always packed with a ton of useful information, links to, as you said, interesting podcasts, articles that you're watching, charts, things that you're pondering. I think it's really worth checking out. Your newsletter is one of the only ones that I always read top to bottom as soon as it hits my inbox, because I do get a lot of newsletters. So check it out. I'm going to put a link in the description below. And thanks once again for coming on. It's been a blast.
Thank you so much for having me. Cheers, Jesse.
Thank you for joining us today. This episode brought to you by ARC Silver, Gold, Osmium. Take advantage of their specials right now. 2023 silver kangaroos, 1 ounce coins, $2.47 over spot. 2025 silver maple leafs, $2.87 over spot. Reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.